Gold just broke below $5,000. Is the safe haven dead? This week, gold, the financial world's age-old safe haven, plunged below $5,000 per ounce. And not just a little drop, a psychological fracture that's sending shockwaves through global markets. Traders are calling it a turning point. Investors are panicking, and everyday people are asking, is gold dead? Is the safe haven gone forever? Today, we're digging deep, not just into price charts, but into the why, the how, and the what now. We'll uncover the real reasons gold collapsed today, the hidden forces moving markets, how major central banks, currencies, geopolitics, and investor psychology all intersect, and most importantly, what this means for your money, your wealth, and your future. By the end of this video, you'll understand whether this is a temporary correction or a major shift in how the world thinks about money. Hit subscribe if you want weekly market breakdowns just like this. No hype, no noise, just clarity. Let's go. Section 1. What just happened? At the opening of trading today, gold, the metal synonymous with safety, stability, and wealth preservation, slid below $5,000 per ounce for the first time this year. Silver, gold's smaller companion safe haven, fell even harder, dropping more than 5% in early sessions. In normal markets, such moves would already be significant, but today's move is magnified because this level, $5,000, is a psychological boundary that many investors have treated as a line in the sand. It's not just any price level, it's a threshold where confidence and fear collide. Several factors converged. Low trading volume in Asia due to Lunar New Year holidays, which makes prices more volatile and sharp, a stronger US dollar making dollar-priced gold more expensive for overseas buyers. Easing geopolitical tensions, reducing the urgency for traditional safe haven demand, profit-taking after last year's historic gold rally. This was not a random blip. It was a coordinated break of support levels that analysts and traders have been warning about for weeks. When multiple catalysts align, both technical and psychological, markets don't move sideways, they break. Today's move surprised even seasoned veterans, and because gold isn't just a commodity, it's symbolic money, the emotional impact echoes louder than the price chart itself. Section 2. Technical breakdown, chart, psychology, and market structure. Now let's zoom in and look at the technical anatomy of this move. Imagine markets like a battlefield. There are support levels, psychological and mathematical price floors where buyers traditionally step in, and resistance levels, ceilings where sellers dominate. For gold over the past year, $4,180 to $4,900 acted as a support zone. Where buyers reliably returned $5,000 plus was a ceiling that once broken opened the gates for further upside. But today, gold broke below support, not just tested it, broke it. Why does this matter? Because support levels are like public confidence thresholds. When they hold, investors feel safe. When they fail, fear and uncertainty spike, and selling accelerates. This is exactly what we saw. Let's break it down. 1. Thin liquidity amplified the move. Asian markets, especially China, were under holiday closures. That means fewer traders, fewer bids and asks, and more price swings on smaller trade volumes. In a liquid market, large orders absorb pressure. In a thin market, a single whale order can tilt the scale. So yes, thin liquidity magnified the move, but it didn't create it. The underlying sell pressure already existed. 2. The US dollar factor gold is priced in US dollars. When the dollar strengthens, gold becomes more expensive for foreign holders, reducing demand. And recently, the dollar has been gaining against major currencies, not because the US economy is exploding, but because of expectations around interest rates and global monetary policy. When safe haven currencies like the Japanese yen and euro weaken, the dollar often rises, and gold gets squeezed. 3. Trader psychology. Fear triggers. Fear. Traders are human. They anchor on levels. They set stop losses. And when critical thresholds break, algorithms and leveraged traders trigger cascades of automatic selling. Today was exactly that kind of event. A technical break that sparked emotional selling and algorithmic acceleration. This is why charts aren't just lines. They represent collective psychology. Section 3. Macro forces behind the move. Okay, Now we get into the deeper forces, the ones that are not just technical, but structural and global. Because when gold moves like this, it's not just a price, it's a message. Let's examine the four major macro forces at play. 1. A stronger dollar and global currency dynamics. The US dollar has been signaling strength lately, not necessarily because the US economy is roaring, but because of relative monetary expectations. When markets believe interest rates will stay higher longer in the US than elsewhere, the dollar rises. When the dollar rises, commodities priced in dollars, like gold, tend to fall. This inverse relationship between the dollar and gold is not new, but it's powerful. And today, currency traders pushed the dollar higher, squeezing gold. This dynamic matters because currency markets are bigger than commodities markets, and gold must flow through currencies to be priced. 2. Central bank expectations. Rate cuts, not rate cuts. Investors built gold positions anticipating future rate cuts because lower real interest rates typically favor gold. But markets are now uncertain whether central banks, especially the US Federal Reserve, will cut as soon as traders expected. When rate cut expectations diminish, gold can lose its shine, at least in the near term. You might say, wait, gold should rally if rates fall. And that's true, eventually. But in the present moment, uncertainty about rate timing created hesitation, and traders rotated out of gold while they assessed the next move. This rotation is what triggered much of today's selling. 3. Geopolitical risk anxiety versus reality. Gold historically rises when fear rises. Wars, conflicts, market crashes, political tensions. But in the past week, some geopolitical pressure points, such as tensions in certain regions, have momentarily eased. For a short period, headline risk was lower, and gold, as a fear hedge, lost some of its urgency. This doesn't mean conflict risk is gone forever. It just temporarily reduced the immediate demand for safe havens. This kind of dynamic often causes short-term swings, and today's move reflected that. 4. Profit-taking after a massive rally. Here's a key point. Gold rallied hard through 2025 and early 2026, reaching all-time highs. Whenever an asset makes big gains, profit-taking emerges, especially when a catalyst, like a currency shift or technical break, gives traders a reason to take profits. Markets love a narrative, and today's breakdown gave traders a narrative, which accelerated selling. Section 4. Why this matters to you. At this point, you might be thinking, okay, gold fell, but why should I care? Great question. And the answer isn't just financial, it's psychological and strategic. Here's why this move affects every investor, saver, retiree, or person holding money in any form. 1. Safe havens are psychological, not just financial. Gold isn't just a commodity, it's a symbol. It represents security. It represents peace of mind. When enough people believe in that symbolism, prices rise. When that belief falters, even temporarily, markets react emotionally. Today's break below a high-profile level, like $5,000, triggered fear because it undermined confidence. Confidence, not fundamentals, often drives markets. So this move matters because it shook confidence. Whether that confidence returns quickly or slowly is the next question. But the fact that it shifted is what makes this move significant. 2. Portfolio implications. Where does the money go? When gold sells off, capital doesn't disappear, it relocates. Here are the common destinations: cash and money markets, temporary parking place bonds, if yields look attractive, risk assets, stocks, tech, growth. If sentiment turns bullish, alternative hedges, crypto, commodities, real estate, depending on risk appetite. This rotation affects markets globally, not just metals. For example, if funds exit gold and flow into equities, it supports stock prices, at least temporarily. If they flow into cash or bonds, that can pressurize other asset classes. Understanding where money flows is just as important as where it comes from. 3. Long-term demand. Still intact, central banks are still buying. Here's a twist. While traders sold gold today, central banks, especially in emerging markets, have been accumulating gold reserves at record levels. This structural demand indicates that institutions still see gold as a long-term hedge. So there's a divergence, short-term traders reacting to price action, versus long-term holders accumulating for strategic reasons. This kind of divergence often leads to high volatility, exactly what we're seeing now. 4. What happens next? Bullish versus bearish scenarios. Let's paint both possibilities so you can prepare mentally and strategically. Bullish scenario: gold reclaims momentum. Real rates fall. Fed confirms future cuts. Geopolitical tensions escalate. Institutional demand surges. In this case, today's breakdown becomes a temporary dip, a buying opportunity that fuels the next leg up. Gold could retest recent highs within months, not years. Bearish scenario: gold weakens further. USD continues strengthening, rate expectations shift upward. Safe haven demand softens long-term, traders rotate into alternative assets. In this scenario, gold could fall deeper, testing lower support zones near structural floors. Even then, it doesn't necessarily mean the end of gold. It would mean a repricing of risk and sentiment. Section 5. What you should do next. So, let's talk actionable insight. What you can do right now. 1. If you're a short-term trader, respect support levels. Don't rely on hope. Watch volume. Thin markets mean fake breakouts. Protect positions. Use stop losses. Short-term markets are emotional. Don't let emotion drive your moves. 2. If you're a long-term investor, look beyond short swings. Buy dips strategically, but with risk management. Consider gold as part of a diversified hedge, not a one-asset bet. Long horizons absorb volatility, but only if positions are sized properly. 3. Diversify. Don't put all eggs in one basket. Consider spreading risk across gold and precious metals, bonds and fixed income equities with real economic exposure, alternative assets like crypto, if aligned with risk tolerance. 4. Focus on fundamentals, not headlines. Markets can shift on narratives, but over time, fundamentals matter. Monetary policy, real interest rates, global growth expectations, inflation trends, geopolitical risk. When you evaluate these factors over time, not hour to hour, you see the real picture. Gold didn't just move, it sent a message. Markets are evolving. Confidence is fragile, and sentiment can flip faster than headlines can capture. But volatility also creates opportunity for those who understand it and stay disciplined. If you want more real-time market analysis coded to human behavior, signal over noise, then hit that subscribe button and turn on notifications. Comment below. Do you think gold is broken forever? Or is this the best buy the next bull run will offer? I read every comment, and your insight could shape our next video. Until next time, stay curious, stay vigilant, and keep learning. This is Felix. See you next time.